Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, Head of Investment Strategy. With an objective to empower you with investment insights, on this program we discuss various perspectives that are shaping the global investment landscape. Defying all the gloom, the global economy surprised financial market participants and economic forecasters by staying rather resilient. The US economy especially not only surprised the economists' consensus but also managed to significantly outperform other developed and some emerging markets in its growth trajectory. In our podcast titled 2023 Mid-Year Macro Outlook Mission Improbable, dated 18th July 2023, we discussed why the US recession hasn't happened yet and offered three key reasons, including the resilient consumer, a property sector not impacted by higher interest rates, and strong corporate sector. Regular listeners of our podcast would be aware of our growth inflation mix framework. On this, the US economy made significant progress over the recent months, with economic surprises continuing to stay positive while inflation surprises turning negative, thereby improving the growth inflation mix for the US economy. In the more recent months, the global economy managed to register positive economic surprises while the inflation trajectory continues to confirm the ongoing disinflation. Looking ahead, from a macro standpoint, we think the US is likely to enter a growth soft patch in the later part of 2024. A range of factors including moderating consumption growth, fading fiscal impulse, moderating services sector, and elevated interest rates are likely to create a drag on economic growth. For now, let us focus on consumption. As the chart on display shows, the personal consumption expenditures are well above long-term trend and growing, while personal income and disposable incomes are starting to moderate, although they remain above the trend too. This divergence between consumption expenditures and income is unlikely to sustain for very long, especially so when personal savings as percentage of disposable income are at their lower end of the 20-year range. Further, as we argued several times in the past, the pandemic era excess savings of the US consumer are expected to last only till the first quarter of next year. This, along with elevated credit card charges, mean a weakening outlook for US consumers. This is likely to result in a period of growth well below the trend, even close to zero. To make things clear, we still do not expect a recession in the US. While we do expect a growth soft patch in the second half of next year, we think it's too early to position for the same, especially when the seasonality of Q4 is supportive of risk. For the context, global equities on average have delivered 4.4% returns between October and December of each year using the data for the last 35 years. Seasonality is also supportive of other risk assets including EM external bonds, global high yield credit, and agriculture commodities. However, the year-end seasonality is not supportive for energy commodities, the US dollar, precious metals, and global treasuries. So with a 3-month tactical asset allocation point of view, we remain overweight equities and underweight fixed income. Recently, we increased our global high yield exposure by upgrading it from an underweight to a neutral. Further, while we remain overweight Japanese equities through our off-benchmark position in currency hedge terms, we trimmed our allocation there recently too. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com. Stay tuned for more episodes of our Q4 2023 Outlook series focusing on equities and fixed income asset classes. You were listening to the Global Investment Insights podcast from ADCB Asset Management, and my name is Kishore Muktinutalapati.